Hey there, good afternoon, and welcome to another weekly update from me, Sean Richard. I'm here with SRT Live. Thanks so much for joining me on this wonderful Tuesday, January 18th. All right, so today we're going to be talking about a number of topics in the real estate and mortgage world. Got some additional data for you as always on Tuesdays, so we're going to talk about that. And then there is some really interesting information that I'm going to take a look at with you today, and it may point us in the direction of forecasting the future. So I'm going to break out my crystal ball a little bit today and see what we can see into it. All right, so first and foremost, let's get into kind of what we had last week. Last week, a little bit light on the news last week to some degree. Last week, we did get on Wednesday, we did get a key inflationary metric. We got CPI, which is the Consumer Price Index. That was on Wednesday. We also got Producer Price Index on Thursday, and I'll talk just a little bit about that. But we got the month over month and year over year numbers for Consumer Price Index. So the previous reading month over month was a 0.8% increase, which is raging hot inflation. The market was expecting a 0.4% increase. We got a 0.5% increase. So inflation still continuing to climb. And as you've heard me say a number of times, inflation is the enemy of interest rates. So if we're talking about mortgage rates, inflation continuing to run red hot is going to drive interest rates higher. Now, the reason we didn't see any significant movement mid last week when that hit is because the year over year numbers, the previous reading was 6.8%. The market was expecting 7%, and we got 7%. So although the month over month number was a little bit hotter than expectations, the year over year number was right in line with market expectations. And because of that, we didn't see a big shift last week. Now, on Thursday, we got jobless claims. Every Thursday, we get jobless claims or unemployment claims. And so this was, we got initial and continuing. I'm going to focus just on initial claims for last week's reading. And so last week, I guess the prior week to that, which is what this was for, we got a reading of 207,000 new jobs created. Last Thursday, the numbers for the actual prior week, the market was expecting 210,000 unemployment claims, and we actually got 230,000 unemployment claims. And this is coming from the U.S. Department of Labor. So a little bit tick up in unemployment claims, and that is going to fluctuate a little bit throughout the year. We've been hovering around 200,000, so this tick up to 230. We want to keep an eye on that to see if we continue to see this as a trend. We have seen we've seen a spike in Omicron cases, and so we could be in a position where some additional companies are having to do layoffs. Maybe they're hopefully not a whole lot of shuttering their doors, but we did see that spike. So we want to watch that on a weekly basis as we go forward to see what trend that we're in with unemployment claims. So that was last week. Today, oh my goodness, packed. So yesterday, the bond market was closed. Not a whole lot of news yesterday. And overall, this week is a relatively low news week. We don't have a ton this week. So first thing I want to pull up for us today is we got the NAHB Housing Market Index, which is from the National Association of Home Builders, NAHB. And so this index basically outlines builder confidence. A reading of greater than 50 signals expansion, and a reading less or short of 50 signals contraction. And so I am going to be pulling that up for us in a moment if it will come up. All right. Leave it to live video for things not to work, right? That's how that works. Okay. So anyways, I'll come back to that. So I do also want to reference kind of what's going on with the 10-year Treasury. Today, we are seeing the 10-year Treasury climb. We've seen it. It's been climbing for a little while. And what I'm also looking at, in addition to that 10-year Treasury note, is I'm looking at the 2-year Treasury note. The 10 and 2, the relationship between them is a key indicator of a potential recession. And so 10-year Treasuries up 3 basis points today. We're up to 185, 1.85 on the 10-year Treasury. And just to kind of give you a comparison, back on December 3rd, the 10-year Treasury bottomed out at 1.33. So we were up 50 basis points in just over a month and a couple of weeks. So really interesting that we've seen that climb so much in that amount of time. But when it comes to the 10-year Treasury and the 2-year Treasury, the spread between them, when those get closer and closer, if we ever see that 10-year dip under the 2-year, or the 2-year exceed the 10-year, that is a key indicator of a recession. And I'm going to pull up the spread chart for you here in just a second. Real quick, I was able to pull up the NAHB housing market index. And so that came in, previous reading was 84, current reading was expected to be at 84, came in at 83. So we're right there. And, that's obviously signaling expansion. And I think if you look at what's going on in the economy with housing, builders just can't build them fast enough. And so the outlook is optimistic for expansion. All right, so let me go pull up the yield spread, the Treasury yield spread chart. I want you to take a look at this with me real quick. And so here, let me share this for us. Boom. Okay, so let's get a little bit bigger here. There we go. So this is the yield spread between the 10-year Treasury and the 2-year Treasury. And so what I want you to notice is the inversion of the yield curve is these red marks, where the 10-year yield dips below the 2-year yield. And so that's any of these red indicators here. Now, these gray vertical bars that you're seeing here, that is a period of recession in our economic history. And so as you can see, every time that we had a yield curve inversion, a yield spread inversion, that shortly after we found ourselves in a recession as an economy. Obviously here in the early 1900s, the 1980s, 1900s. I was trying to look at it on the small screen versus the big screen. Then we also have, the 90s, we had a recession follow. We had in the early 2000s, recession follow. 2008, recession followed. And then if you can see this itty bitty little red dot right there, a tiny tap on an inversion. And then we had a little bit of a recession in 2020. And so what I want you to pay attention to here is look at this trend right here. Follow my mouse here. So we are trending downwards, and we're trending quite vertically right here at the end. And so we've only got a spread of about 75 basis points between the 10-year and the 2-year. And so we were in the 80s last week, and that's trending downwards. So if we do see the 10-year dip below the 2-year on the Treasury, that could spell recession. Now, what happens in a recession, right? Who knows? Raise your hand. Oh, you're on Facebook. I can't see you. It's okay. So in a recession, 2 things primarily happen. Three things. One, the economy slows down, right? So on that note, we want to keep an eye on GDP. GDP, the forecasted readings have been declining a little bit, which is also a potential indicator of recession. Number 2 is the interest rates from a mortgage perspective decrease. So we could find ourselves in a period of declining interest rates. And then number 3 is home prices continue to rise. And I know that might be a little bit surprising, but typically in a recessionary period, the home prices do continue to rise. So that's a positive for all of you homeowners out there. If you are not a homeowner and you're looking to buy, then that's a positive for you, because if you buy, you're going to continue to see periods of increased appreciation in home value. Now, what's happening right now? So inflation is running red hot. Interest rates are on the rise. Let me pull this up for you. I'm going to show you mortgage-backed securities, which is a direct relationship with interest rates. And so they have an inverse relationship. So as mortgage-backed security prices go down, interest rates go up. So red in this chart means interest rates are likely rising. So here's what I want you to look at here. Boom. Look at all these red days. 8 out of the last 11 trading days have been a decline in mortgage-backed security pricing, which is driving interest rates up. So interest rates are on the rise. A lot of that has to do with inflation. Inflation's still running red hot. So we want to keep an eye on that. So that's what we're seeing in the mortgage world right now. Now, we also got some data from CoreLogic, and this was the CoreLogic rental report for the month of November for single-family residences. And it showed that rents are up 11.5% year over year, November of 20 to November of 21. 11.5%. So that $1,600 rent that you've been paying is actually, what's that? 11.5, gonna go up to $1,784. That's $184 increase in a single year in rents. So when you've got a mortgage, you've got that principal and interest payment that is fixed for the entire life of that loan. So you have a fixed payment in a period of inflation. So, well, although the rest of your money doesn't go as far, right? You go to the grocery store and, that $10 that you spend at the grocery store now only buys, what used to be $10 worth of food. Now it only buys $8 worth of food. Your money is getting weaker. However, you have this fixed asset in a home where your payment does not shift with inflation. It stays the same, which is phenomenal. So the benefits of home ownership are to help your money work harder for you. If you have a $1,600 mortgage payment and that $1,600 is no longer worth $1,600, it would take $1,800 to buy the same home, then you are making more on your money. Your money is worth more because it's fixed into that payment. So that's fantastic news if you're looking to buy a home. Let's go into let's look ahead to this week. Again, somewhat of a quiet news week this week. We've got let's see, tomorrow we've got a couple of data points that are coming out. We've got building permits and we've got housing starts. So building permits is when permits are pulled on new housing, and that's indicative of future builds. And then we've got housing starts, which is really that next phase for builders. And this is coming out from the U.S. Department of Commerce. So that's coming out on Wednesday. And then on Thursday, as usual, we've got the jobless claims, unemployment claims. So we'll keep an eye on that. As I mentioned a couple of weeks ago, 230,000 new claims. We'll see what this Thursday's number brings for last week's claims and try to get a feel for where we're trending on that. So I hope this was some phenomenal information for you to take out to, if you're a real estate agent, take it out to your clients. If you're a homeowner or a home buyer, I hope this helped you understand the market a little bit more so that way you can make better decisions, more educated decisions. If you have any questions at all, don't hesitate to reach out to me. You can reach out to me by phone. You can call or text me. You can always email me at sean.richard@rate.com. Happy to help out. Thanks so much for joining me on this edition of SRT Live. I'm Sean Richard. Have an incredible rest of your day.